All right, thank you guys, everybody, for joining me today. This is being recorded. One thing I say at the beginning of all these webinars, and I know some of you probably think I'm a broken record with this, but watch it again because first time through goes into your short-term memory. Second time through, it'll stick into your long-term memory. And yes, I know you guys can go out online and find out how to do a long put calendar. It's pretty basic, actually. But I'm going to talk about different things that you're not going to be able to read about online. I'm going to give you some specific rules to follow with this to increase your probabilities of success, and you're going to need to stick to those pretty tightly, especially with this one, because there's some things I'm going to talk about that can really lower your probabilities, and I'll get into that in more detail in a second. But let me get a couple of things out of the way real quick. For those of you who haven't joined us before, my name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started trading in college with some money I had earned, and with a psychology degree. I went there for psychology, started trading, and decided to switch my degree over to finance. And then after graduating college, I moved to Chicago and started working on the floor of the Board of Trade. I was actually like one of these runners that would run around to the pits, and then sold all my stocks and stuff like that I had been trading in college, and bought myself a badge, jumped in the pit, and started trading. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, and basically all market conditions. As you can see, this was a real fun day. Anyway, you can follow me on Twitter at Wolfman's blog. You can also follow the parent company at ProTraderStrat. This is a really good time to be following me on Twitter if you aren't already, because I kind of tweet out some of the earnings trades that I'm doing. So I'll tell you which stocks I'm doing and stuff like that. I don't really give the exact strike location, but if you've watched those earnings webinars, you know exactly where I'm going with those. So I stick to those rules according to those webinars as well. And got to go over this disclaimer. Basically, any opinions, news, research, and analysis or other information contained here or material provided by ProTrader Strategies and associated companies or employees is for general commentary, does not constitute investment advice or solicitation to buy or sell any of the securities or strategies. You guys, what this basically boils down to is if I don't know your risk parameters, I don't know what's in your portfolios. So what I'm doing could be counterintuitive to what you're already doing. So take what we're teaching you in here and implement it in your portfolios in your own way. We're here to teach you guys how to swim, not to swim for you. And I don't necessarily want you guys to limbing off the cliff with me, but I do in my daily market commentaries talk about every single trade that I do and how I manage those, when I'm getting in, when I'm getting out, and all of those fun things there. And I also talk about the economics and geopolitical stuff that's going on as well. Talk about all the economic numbers and what I see in them, how I think they're going to affect the overall markets too. All right. Basically, bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. Okay, this is what I was talking about with, yes, you can go online and figure out how to do a long put calendar. I don't do the short put calendars, you guys. There's just way too much risk involved in that long duration short put if you were to do that, and I don't suggest you guys do that either. So I won't even do a webinar on it, because at the end of the day, I'll never implement that strategy because it takes way too much time for that short put calendar to decay, and there's way too much risk involved in it. But with the long put calendar, I do like it, and especially coming out of earnings, I like to put this strategy on because that has the tendency to get higher implied volatility, right? When we're around earnings, all of these stocks that have earnings coming up relatively soon have about the highest implied volatility they're going to see until the next earnings cycle. So while implementing this, we're outside of those earnings, but that put we're buying is going to be in that earnings cycle. Now, I'm not going to ride it through that earnings because then the volatility comes out of it, right? So what I'm trying to do is capture volatility expansion on it. Now, online, usually you're going to read about this and it's going to say selling an at-the-money put, buying an at-the-money put. I usually go just slightly out of the money on these puts, and I usually kind of go somewhere around the 36-ish delta. It's about a half a standard deviation away, 45 to 36, depending on how bearish I am on this underlying. If I think this underlying is going to continue to kind of slope at a downward trajectory, then I'm going to be picking the 36 delta. If I think that there might be a little bit of a bounce, which would be a good time to put this strategy on and then continue on. Some of you guys that are like really into the charts might see a little bit of a bounce and then think that it's going to continue on. Then I would pick something like the 45 delta. So if you're a little less bearish in the near term, but more bearish going forward, then you would do closer to at the money. But I usually am picking the out of the monies with about a 45 to 36, depending on my bearishness, I guess. So I see a couple questions coming up. Are you still trading on the floor? No, I'm off the floor. I've been off the floor for probably about 4 years now. The half a delta is 40 delta. Half a standard deviation is right around the 36 delta. All right. Could we use weeklies for the short and a monthly for the long? You absolutely can. I don't like to go into those weeklies necessarily and do this, but you definitely could, especially maybe like on an ETF or something like that. I wouldn't necessarily do that with the ones that are going to have an earnings event, like, you know, let's say in the next 35, 45 days, because the idea is to get that, put your buying away from theta decay, and theta decay really starts happening rapidly, you know, inside of 35, 45 days to expiration. You start seeing rapid theta decay in there. So I don't like to do that. I'd like to get a little bit further out on that line then. Okay. All right. So, all right. The essentials to success with this is picking the right underlying, you guys. This is the first step in the process, basically. And picking the right underlying means basically when you're looking at the options chain, they have tight bid asks between the calls and the puts. So here, I'll pull up the trading platform real quick. And what I mean by that is a tight bid ask is something that is going to be, let's just look at it, like AT&T, for instance, and go out. Usually I'll check this with the nearest full month. And you want the bid ask to be inside of 10 cents for a stock under $100. So between the bid and ask on the calls and the puts that are, you know, closer to just out of the money, those need to be about 10 cents wide. Anything over $100, you know, for instance, I think I just had up like Facebook. Anything over $100, this is going to have a tight bid ask because it's Facebook, 10 cents wide. But if it's over $100, move the decimal 3 ticks to the left, and that's how wide the bid ask should be. So, you know, in a sense, Facebook being inside of 17 cents. Same thing on a $300 stock or more, you know. $300 stock would be 30 cents, okay? But, you know, everybody's heard of something like Aon, and Aon has, you know, it's a $140 stock, you know, similar to Facebook, but as you can see, the bid asks are really wide. And the problem with that is you have to give up so much edge to get in and so much edge to get out that it's going to eat up basically all of your profit. Think about it. When you have theta decay happening, especially if you're trying to sell it, if I had theta decay happening and it's decaying at like 2 cents a day, you know, I could be in this trade for 2 weeks and have to get out at the same price that I got in. and you're taking on all that risk, it doesn't make sense to do that. It doesn't make sense to take on all that risk for no profit. So make sure the bid ask is really tight. And another reason for that is there's also always somebody in there willing to give up a little bit more edge when there's a lot of competition, if you will. So if it's 5 cents wide or something like that, and something like Facebook, you might only have to give up like 1 penny to the upside to bid, and somebody will hit you because they know somebody else might hit you first. So there's a lot of competition in there. A lot of volume and open interest is what we're looking for in something like any stock that we're looking for. So you can always even just double check on volume and open interest. You can see there was just basically nothing as compared to Facebook is going to have huge amounts of volume and open interest. And that's what I'm talking about, is you give up a penny here or maybe even 2 cents on this bid or offer, and somebody is likely to come in and better the bid or the offer opposite of you, because that's what creates the free markets, is people giving up those edges. All right, so the next thing to look for is picking the right strikes. Now with this one, it may seem very intuitive. It's the difference with say a calendar spread versus like a diagonal or any other put spread is this is a horizontal spread, which means it goes out across the calendar. Okay, we're picking the same strikes, whereas a vertical spread is where you're picking different strikes in the up and down fashion, like a 50 put and a 45 put. That would be a vertical put spread, and a diagonal is basically a calendar spread, but you're doing a vertical spread in there. This is all horizontal, but it's important that we're picking somewhere between the 45 out of the money strikes and the 36 delta out of the money is what I look for. So picking those strikes, so look for those deltas, and we'll talk about that a little bit more in detail here. All right, picking the right duration. Now, this is what I was talking about with those weeklies, okay? Those weeklies are going to see rapid theta decay, and it's going to decay a little bit more, but I'd like to go out here a little bit further on the options chain, because this is a representation of how fast your options are going to decay. All right, and we want to kind of sell inside of this one and buy outside of here, because you get that rapid decay quickly in that front month. So that's what we're trying to do on this one, is exploit theta decay here and take advantage of it here. The other thing is, as volatility starts coming into this market, we're going to see volatility want to hold off this. So what it does is when volatility starts coming into the market, this will kind of flatten out, okay? And the reason why we don't want to hold that long put past the binary event, which is that earnings, is because as soon as volatility comes out, the premiums do that and just do a nosedive. So the only time I'm going to leave this strategy on possibly through that earnings event would be as if it was already looking like it was a full loser. And I've got nothing else to risk in a sense, except having on a free, long put to hopefully come back in my favor. But if I'm profitable at all on this, I'm not going to ride it into that earnings event, because you could be directionally right, but when that volatility and that premium comes out at the same time, you might be directionally right, but all of that money coming out could cost you your profits. And I talk about this all the time in those earnings webinars and in the daily market commentaries, how I had four earnings plays in one day all be directionally wrong, but I made money on all of them. And that was because the volatility came out of it, and that's what I was playing. But in this case, we don't want the volatility to come out of that long put. We actually want volatility to increase, because same thing, if volatility is really increasing, we could still be directionally wrong and not be losing in some cases. We could actually be profitable if volatility really spikes. So taking advantage of the different decays in theta here is important. And picking the right environment. Now, this is really important too, you guys, because again, online, they aren't going to tell you a specific rule in and around the environment that you need to be successful with this. Now, we want really low volatility, or low vega, low implied volatility around the underlying we're trading. And as a matter of fact, one of my rules of thumb, it goes for the long call calendar, and I forgot to mention it in the last webinar, is, it's best to get below an IV percent of 15 for these different underlyings. And the other thing is on the options chain, we're going to be able to look at different volatilities of the underlying, and we want it to be pretty close in relationship, okay? Facebook has some earnings coming out, so let's go down to something that doesn't necessarily have an earnings in it, and I'm just going to try and find the one that's going to be a close representation of what we're going to finally look at, and not necessarily that I'm bearish this, but this has the earnings coming out in January. So, that 45 days is where we're kind of looking for that theta decay here. You could go inside of that to like the 21, and somebody mentioned, can we do the weeklies? Yes, I usually stay away from it and go with the monthlies. The only time I really trade the weeklies is actually for earnings. But we want the volatility over here on the side that we're looking at. This is the implied volatility for these underlyings to be relatively close also. Something below IV percent of 15. This has 1503. So that's, bending that rule just slightly, but 1503 is close enough for government, right? As a matter of fact, if we just look here and it rounds it up, rounds it down, we got 15. So that is one of those things we're looking for the environment. Current IV percentile is 15. So the months we're dealing with, we need to have those in close proximity to one another. And my rule of thumb here is 2% difference. And this is that the 18 to 21, right? Yeah, 18 to 21 is outside of that. So that would be stretching it. In the past, a few years ago when we had higher implied volatility across the board, I was having this rule was less than 3% difference. When we have higher implied volatility across the board, or the VIX goes up, that rule is, going to come back into effect. But we've had such low implied volatility lately that I've kind of tightened that up to 2% difference. And the reason why is because if you allow this to get wide, what you're doing in this month that you're buying is you're paying more for volatility. And we don't want to do that because you can't offset a lot of that by selling those nearer ones. You're selling less volatility than you're buying. Now, generally, the case is going to be where you are paying more for volatility out here, because volatility affects these further durations more than it does the nearer term, but we want them to be relatively close. So, less than 2% is a real green light, which means, that's a good go trade. As you're going through the rules, checking these things off, that would be considered a green. Less than 3%, kind of a yellow. I usually stay completely away from it if it gets outside of 3%. That's pretty much a red light in a sense, where I'm kicking it to the curb, moving on to the next one, because there's a few things that we can control, you guys, and one of them is the setup of these strategies. And the setup of these strategies is imperative to your success, okay? And you can bend these rules every once in a while, like I said, 1503, maybe even 1537 might be something you could bend the rule on. But at the end of the day, try and keep it below 15 and keep these over here tight, which means, less than 2% difference, and possibly, if you really liked the bearishness, or you were really bearish on this and thought this was a really good one, make sure it's within 3% on that. Okay. Is the direction of the underlying of a long put calendar bearish or bullish? Good question, Caesar. It's bearish overall. You don't want it to necessarily fall out of bed right away, because that could actually hurt you. You really kind of want it to trade sideways, maybe even slightly higher. Maybe you get like a dead cat bounce in this underlying. It's kind of come off. It's in a bearish trend, but a slow, long downturn would be the best for it. But a little bounce won't hurt you as long as your long-term directionality assumption is bearish. Because ultimately you would love to have this front put that you sold expire, just out of the money, so that you get full bang for your buck on what you sold, and then kind of ride that long put out. So, you'd love to have that happen. There are situations where it will go down, but if you get that implied volatility coming up, and the beauty in having the puts, I don't know if you guys are aware of this or not, but usually the market can spike higher and you will see volatility come out. Kind of like what we saw today. Even though the market spiked higher in, like, say, the NASDAQ and stuff like that, the VIX got crushed. So, that was volatility coming out of there. But when markets have a tendency to move down, volatility goes up relatively quickly, and that will help you in this this spread here. Okay, so the short strike put will collapse the high vol near the earnings, so you can buy it back cheaper and close the long put soon, so you don't want to get hit with the vol crush, right? Yeah, bottom line is you don't want to get hit with vol crush on this strategy. You want volatility to expand, which is why you want to set this up where this long put we're buying in FedEx, and I'll show you, we can pull up a real quick chart here. There's the Amazon blast off today, up $128, but let's just look at FedEx to see where their earnings are. And when you put this chart on expansion, you can see exactly where their earnings are, which is nice. So they come right into that January contract right here. So if you were bearish FedEx, the volatility, as you can see, just as in the past, this would have been the similar situation where you're setting it up here. Volatility starts expanding as you head closer into that earnings event. It did kind of come off a little bit here, but you can see the volatility crush usually happens right after that earnings. So you get that kind of slow increase there, and then boom. So that's why you do not want to ride this past that point. Unless, of course, like I said, you are at a full loser on this strategy, then you pretty much have those puts on for free. So what more are you risking at that point is the way I look at it. If the market was continuing to rally, then you're kind of just looking for real directionality at that point. All right. I think I saw a couple other ones. Long calendar is a bearish strategy to be used as a hedge. You could, David, or John, sorry. You could use this as a hedge. I don't. I just use this for exploiting volatility expansion and directionality, but I don't really use it as a hedge necessarily. But you could if you were long the underlying. Volatility will. John's asking, won't it affect both strikes? Volatility will affect both strikes. Yes, that is going to happen. But as you can see, as you go out in time, volatility goes higher. And that's because volatility will affect the further or the longer duration contracts more than it will the nearer term. So your long put will be affected more and will expand more than it will the nearer duration one. So we could kind of look at volatility and open interest here and see the Vega there. It should have a little bit more volatility in the nearer. So you can see like the 240 strike here has a Vega of 41, and the 240 strike here has a Vega of 27. All right. So, if you want to compare apples to apples, you can see that going out on the curve or going out in time, volatility will affect those same strikes more further in duration. Okay. Is it the 2% differential also applies to the put and call spreads with the same expiration? No. Well, not with the same expiration. No, I don't usually do that with the puts and the calls on the same expiration. So it's really only affecting on the calendar, and it also comes into line when you're doing a diagonal as well. If you were doing a long diagonal, you would want those closer. Now, there are situations where you will see the volatility in this front month be higher than, on the rare occasion, than this further duration ones, and that is like a real green light, because then you're getting paid for volatility more in the front than you're paying for volatility in the back. Okay, and you would expect that to revert back to normal and go in, backwardation is where the back is down, is an easy way to remember it, and contango is where the back is higher. But if it were in backwardation, where the volatility in the front was higher than the volatility in the back, and goes into contango, then you're getting both, right? You're getting paid both, because volatility, assuming, is going to stay lower, and that volatility in the back goes back to normalization. You could get paid even faster on this strategy. Does that make sense? So you have volatility expanding several days before the earnings. Yes, you do, and that's what you want to take advantage of. Correct. All right. All right. Oh, I got this still up. Let me get to this. All right. So that's picking the right environment. All right. And knowing our exit strategy before entering this trade. Okay. We want to look for something like a 30% increase in value in this. And that's usually where I'm looking to get out of this. And one thing I talk about with knowing your exit strategy before entering trade, once you figured out what your exits, what your strategy is that you're going to get in, write down the reason why you're going to do it on a folder or something, and list the day you did it, why you did it, what you were thinking, and then write down for sure what your exit strategy is, you guys. You will be more likely to stick to that if you've written it down than if you put it in your head. And being mechanical is the utmost importance in trading. I've seen too many times, too many people go out there and say, you know what, I'm going to do this, that, and the other thing, or I'm going to put on this trade, but I'm getting out here. And it gets there, and they're winning. And they were like, well, it looks too bullish right now. I'm actually going to hold off a little bit longer. And then that's when they get stung. There's a saying on the floor, bulls and bears make money, but pigs get slaughtered. And that's what that means, is you can be a bull, you can be a bear, get out while the getting's good, because if you start getting greedy or whatever and start pushing your luck, that's when you're being a pig and you're going to get slaughtered. So write down what your exit is and stick to it. Now, my rule with this one is when the position increases by 30% in value, that's when we're getting out. Okay, so for instance, you paid $1 for this strategy. We're looking to get out when it increases to like $1.30. Okay, now if you're doing these in one lots and stuff like that, you might want to increase that slightly, maybe a 40% increase, so that because of the commission costs and depending on how much you're paying in commissions, somewhere between 30, maybe 30 to squeeze 40. But write it down. If you saw a technical spot on the chart, maybe that's the place you get out. if it went down and achieved that. All right. Now, if we're directionally wrong in this, this, like I said, that's when I'm going to ride this through the earnings. I'm just going to, if I paid that $1 and it starts going up, then I'm just going to leave that long put on for a free ride at the earnings. Okay, but an increase of value of about 30, maybe squeeze 40%. Do you enter a GTC to exit that at 30%? I don't always, Dan, but when I start seeing it get close, and I do put in more GTCs in my IRA than I do in my margin account, but and I don't know why I do. It's just kind of a quirky thing, but I'm mostly in my margin account, like going back and forth on stuff, and I don't like to have all of those. I trade more in my margin account than I do in my IRA, and I don't like having all of those in there that I have to sift through, all those working orders. But I'm a person that's in the markets every single day, all day long, so I'm watching all of this stuff quite in minutia, if you will. Like I'm keeping a real close eye on it, and pretty much know where my exits are on all of those. If they start to get close, like I had UAL today, and I have on a short put spread in my IRA, and in my margin account I have short puts on, and I saw it getting relatively close today. I mean, I think I was like 10-15 cents away, but that's relatively close to my exit. So I put it in there just in case, so I wouldn't miss that. But I did only put that in as a day trade. I didn't put that in as a GTC. But I will do that when it starts getting close. If I'm like, 10, 15, maybe even 20 cents away on a day like today where the market was going up, I didn't want to miss that. So I went ahead and entered that trade. So when I'm getting close, I will start entering those a little bit more often. Does that make sense? And in my IRA, I will have a tendency to put in a GTC relatively soon after entering that trade, but I don't usually do it right away. If you're not in all day long, every day, then that I think is a good practice to put that in, so it doesn't happen when you're not watching. Okay, so for this long put calendar, have volatility expand. We should use this strategy several days before earnings. Correct. As a matter of fact, several days being, 70, 80 days. That's the perfect, 45 days in the front and, 80 some days in the back is usually where I'm looking at. Because then you're getting into that volatility contraction, you're getting into that theta, rapid theta decay in the front. I wouldn't do this like, the back month being 100 and some days and the front month being, 70, 80 days, because you're just not going to see that theta decay in that front one. You're going to be fighting an uphill battle in a sense. All right, so max profit. So, the idea is it's very difficult with this one to figure out what your max profit is. I'm going to show you a couple of other little rules here when I pull up the platform that shows a different max profit. But the idea here is really the max profit's unlimited, at least unlimited to zero, which isn't likely going to happen, but that's because you're long that long put if the front month has, expired. All right. But I wouldn't be a hero and go for that. The other thing is your max loss is going to be the premium paid. The beauty in debit spreads, and this is a debit spread, it is a long put spread. Anytime you get that long in there, that means it's a debit. That premium you paid is the most you can lose. And another thing about this strategy is, you're selling that front month put to help finance some of that premium in that back one. So really you're kind of, synthetic, you're buying it lower than what it would normally have cost you. All right, so your break even is you take that long put option and subtract the premium paid. So say for instance we did the the 50 strikes, the 50 calendar, and we paid $1, then when the underlying is trading at 49, that's where your break even is. All right, so let's pull up the platform and we'll go over some different things. This is usually where I throw it out to you guys to put out some stocks. We'll go through it, all of those steps, those essentials to success, to see if it fits all the rules and whether or not we could implement something. And I've vetted a couple in case we can't find any that would fit my book and my directional assumptions. So like I said, don't necessarily limit off the cliff. They're my opinions. So and believe me, I'm not always right, but one of the things that we can do to increase our probabilities of success is setting this up in the correct environment. So one of the things I also forgot to mention here is current IV percentile. Maybe not all your platforms will have that, but most platforms will have implied volatility down here at the bottom. And the way to figure out that IV percentile is basically what this is doing is taking where the current IV is of 17 here, and you have a numerator and a denominator in this fraction to figure out that percentile, all right? And it doesn't take into account time. It doesn't take into account, most times it's hitting those locations, but it's a good indication as to the IV percentile. So you take 17 and you take that, you have a sum in the top and the sum in the bottom. The sum in the top, we're taking 17 minus the low, current minus the low. So 17 minus, let's just call it 15 for all intents and purposes. So 17 minus 15, we have 2 in the numerator, and in the denominator, we're taking the sum of the high 32 minus the low of 15, so we've got 17. So 2 divided by 17 would give you close to 15. All right, so that's where you're doing that. All right, and the idea here is when it's below 15, you can see it spends a lot of time right in and around this 20 area, right? So the idea is that not only you aren't always going to be right, volatility could come off on you. Still, we never necessarily know, but the probabilities are if volatility starts coming out, that front month is going to decay faster. But then going into these earnings events, you can see earnings, it kind of spiked a little bit before that, came down, and then, you don't want to be involved in the volatility crush. But you can see volatility expanding into the earnings, and then boom, same thing here. Volatility expands, and then boom. We don't want this to happen to our long put, because that will be a travesty. All right, so let's look at a couple. So NVIDIA, and I'm not necessarily bearish on NVIDIA, but I do think they have, a lot of these techs are coming out with their earnings coming up. So let's just see when their earnings are. So it does come in that next month there. So if you were bearish NVIDIA, I would look to, this is where you're going to be kind of in that 45 days, but you only have 21 days here. But let's look at it. So let's shrink that NVIDIA and look at the trade thing here. So like I said, we're going to need to sell these then and buy these, which is going to get that theta decay, but hopefully these will decay faster. The next thing to look at is the bid ask. NVIDIA, $200 stock. What's the rule? We go 3 ticks to the left. It's got to be 20 cents wide. 50 to 70, that's 20 cents wide. It makes that rule, and NVIDIA usually is in and around that 20 cents, or sometimes even tighter than that. So we're looking at this one more for that rule on the right underlying than going out here and picking something in the March, okay? Because the March is not going to likely fit that rule. So you're picking the front month, not the weekly, to figure out that rule. So that fits that rule. Next thing to look at is the volatility here to the volatility in the one that has the earnings. So is that's a situation where, am I right on this, where that chart was showing NVIDIA makes it look, usually the one that has the high implied volatility is going to be the one that has the earnings in it. This is making it look like the earnings for NVIDIA are, where did my chart go for NVIDIA? I have to pull up a different one. I don't want that chart. I'll just switch it. Let me just double check NVIDIA. So oh yeah, so the earnings are right here. I must have had the wrong chart up on that one. So NVIDIA has that earnings in here, so we don't really want to do that. I don't know how I messed up that other chart, but all right. So NVIDIA, I wouldn't want to do that in this one, okay? Because we don't want the earnings, especially in that front month. We want it to kind of land out here. But it does fit the rule of being able to trade. The other thing is, because those earnings are so close, it's above 50. We want something that is really low. So AAP, advanced auto parts, high implied volatility, but I do want to show this one because everybody's heard of advanced auto parts, right? It's an $81 stock, but look at this. Those are almost $1 wide, you guys. So, I mean, I don't even have this on my watch list over here because I would never trade it, because if it's that wide, to get in and out is going to be very difficult. And when you look at volume and open interest, you can see not very many contracts have traded there. You know, you're probably going to have to, you know, if you wanted to sell these puts over here, we'll look at the puts. I always have a tendency to look at calls first. But if you wanted to sell these puts that were just out of the money for this strategy, you're going to have to give up so much edge to get in and out that that it's going to end up eating away at all your profit. And those pennies count over the lifetime of you trading. Those pennies will count. All right, so the next one was IBM. Let's look at IBM, see if it follows the rules. $150 stock. So 3 ticks to the left, we should have $15, and this is inside of that rule. Trust me, those ones right at the money are 10 cents wide, and you can see there's a lot of volume and open interest going on in IBM every day. So that would fit. The next thing to look at would be when their earnings are. So we want to try and nail that thing. We want to make sure we get that. So let's look at IBM's earnings. And IBM is a little far out. You know, we would love to, yeah, that's the 45 and that's the January. So let's look at that one. So the D's and the Jan is where we get that earnings. That's like right around that 3%. That'd be that yellow. You know, if it's just slightly over 2%, you know, I'd still say that's a green light. You know, if it's less than 2%, that's like, you know, a screaming green, neon green, let's call it. Just slightly outside of 2%, I would still let it happen. This is just outside of 3%. Let's just look at the charts to see how volatility is in relation. You know, it very well could start ramping up consistently, though. So, you know, you look at this, just look at the past volatility on it. Actually, let's look at the other chart. It's a little bit better representation of that volatility. So I'll pull this up a little bit higher so we can see it, if it's going to let me. Right, so you can see when, I don't know when their earnings or when their dividend is, but you can see that right after the earnings, they get slammed, and it does have a tendency to consistently move higher. So in that regard, you know, that might be one of those ones where you bend that rule just a little bit, you know, but you really need volatility to expand for you heading into that earnings event consistently for it to work out. if you're bearish on IBM, which, you know, the market is bearish on IBM. I think what they're doing, they're getting away from the low margin, high cost aspect of their business, the sales and all that stuff, and getting into cloud, which is high margin, low cost to facilitate. And people don't like that, and I don't understand why. Amazon's doing very well with their cloud services, and I think IBM will too. So I would be more bullish on IBM, but that's just my take on it for that one. But if we wanted to really do that, being bearish on it, I would go and look at the deltas. So I spoke about, you know, like the 35 delta. So we'd be picking about the 50s here. You would want to sell these puts here and then go down and buy the same strike, the 150s. So we're going to be buying the 150s here, and you hold down that. So $1.50 or $150 per one lot. Now, one thing I want you guys to know with this is to go in and then look at the Analyze tab. Now, this is what I was talking about with the Analyze tab on the spread here. It's giving you a max profit here of just over $150. Your max loss is right around $150 too, right? So this is a situation where we're looking at it. Your risk one to make one. That's another green light on this. If you have the Analyze tab, you can do that. So risk one to make one. Now, something to note, when the volatility increases, watch what this is what I was talking about. When volatility increases, you can see that max profit. Watch this up here. The bottom's not going to move at all because it's a debit spread, right? That's the most we can lose. But if volatility expands for us, you can see that we could make money faster and make more money. So that's because this back month is getting, or the January is being affected more than the front month, okay? But, you know, again, on the flip side of that, you know, if this were to go negative, you'll see that comes down. So as, you know, this starts going down, you can see that would hurt us. Okay, so we don't want that to happen. So a green light for this would be risk one to make one. If you're risking one to make like half, so if you're risking $150 to make $75, this would not cut it. All right, you guys, you want to at least risk one to make one. And say that's like a yellowish light. You know, if you really like the trade, then you might do that. A green light would be risk one to make two. So if I was risking, you know, $1 to make $3, then that would be something I would really look at, or risk $50 to make $150, and you will see that happen. That would be a really good green light. Somebody, Caesar, Chipotle, CMG. Let's look at CMG on that, because I'd be bearish CMG. They're kind of like a dumpster fire right now, aren't they? But they just had earnings, so CMG is kind of a dumpster fire, yeah. They lost money, and nobody likes their con queso. I don't know how you can mess up con queso, but somehow they've managed to do that. So Chipotle, $200 stock. So we want it to be about 27 cents wide, right? Chipotle usually is inside of that. They have probably high implied volatility, yeah. So that's going to also, high implied volatility will have a tendency to widen these out a little bit in the market. But look at these here. So 27 cents wide. I haven't traded Chipotle in a while, but I know there's a lot of volume and open interest in here. So I would think that it's basically because we're a Friday and nobody's leaving anything in there over the weekend in case somebody, you know, gets salmonella again or something. But it has too high implied volatility for me to look at this. how did you read the risk reward rations of the analysis, risk profile, 1-to-1, etc.? I'll do one here in a second once we get over it. So I'm going to go to the one that I'm bearish on real quick, just to kind of give an example that kind of fits it. It doesn't have earnings in it. You know, a lot of them, I was looking at IBM, Nike. We could even look at Nike, but one of the things is the ones that I would be looking at aren't really fitting that inside of, you know, 2% difference. You know, Nike has just inside of 3%, so 2.5%. So we could say it's a yellow light if we were really bearish on Nike coming into their earnings, just to double check on their earnings. Let's pull up the chart. NKE. You know, so the earnings fall in the January contract. It's on the 19th. This expires on the what is it, the 15th. So we could do that as an earnings setup if you're bearish in Nike. And the only reason why, oh, it's got 29%. So what was the one that I was looking at that had less than and had? I don't think any of them fit that. FedEx was the one that I already kind of talked about. FedEx was the one that I kind of already talked about, and that was a stretch on that also. I mean, that's 3.5, so it doesn't really fit. So none of the stocks are really working. So at the end of the day, I wouldn't do it with those, okay? You don't have to do it. Don't force yourself into, you know, even if you were bearish, there's other strategies that are better than the calendar if these rules don't come into line. You know, and I talk about that in all those other webinars. You can find one that would fit your bearish assumption that would be better for a situation for like FedEx or Nike than this. You know, it's just kind of like, all right, that doesn't fit with a long call calendar. So, or sorry, long put calendar. So let's look at GLD, because I think GLD is going down. But you know, having said that, the way I'm looking at this strategy is, you know, the economy is going better. You know, we just had 3% GDP, which means people are going to be pulling their money out of the safe haven of gold, and they're going to be throwing it into the stock market. So I think that people are going to be looking to do that, and in that, I would be more bearish in gold. But if you guys watch many of my daily market commentaries, you guys know I, as a technical trader of the market profile, I think that we could see it bounce on this line a little bit, but I do think that it will eventually come down and test this value area low here, which is, you know, most of the time and volume has been spent in here, but I do think it will come down and at least test this. It may take a little while, but I do eventually believe that it's going to do that. If we start seeing it come down and test that area, I think we're going to see volatility expand as well. So that's my thought process going through with this. It's a $120 stock, so we'd want to look at this and make sure that the bid ask is inside of 12 cents, and it is, as you can see, huge amounts of volume and open interest in GLD. It is one of those things that everybody trades for the most part. So I'm going to be looking at it. I'm going to go a little bit further out because you know, I'm going to go somewhere between that 40-ish delta and the 36 delta. So I'm going to be looking at this one. So I'm going to sell this here, and then I'm going to go out and buy the same strike out here. So and that gets me right there at that 35 delta there. So 43 cents. I'd be paying a 43-cent debit. So John, going back to your question on that risk reward thing, we could look at this, and you can see I'm risking $40. Risk one to make one would have been risking $40 to make $40, but risking one to make two would be risking $40 to making, you know, almost would be $80, but this is all the way up at 100. So I'm like risking one to make 1.5, and that's not necessarily the place I'm going to be getting out of this. But you know, and since I'm paying so little for this, I'd probably be getting out of this at like 80, you know, somewhere between 70 and 80 cents, which would be a little bit more than that, you know, 30% increase. But if this only increased by 30%, it's probably not going to be enough for me to even cover my commission. So I'm going to have to be willing to have a little bit more increase in that value. So think of it that way too. You know, that 30% increase is because usually you're going to end up paying around $1 for it, but this set up so nicely that you can get it for 40 cents. That's very cheap for a long put calendar. Does that make sense? So that's what I'm talking about with that. Yeah. Does that make sense to everybody? Can one do a calendar trade 2 or 3 weeks before earnings, provided IV, delta, and gamma offset effect, and take advantage of the, you know, yes, if everything else goes according to plan, where the volatilities are relatively close. But the thing is, when you guys are when we're getting closer to that earnings event, you're going to, the closer you get to that, the more discrepancy we're going to be seeing between these months here. Okay, who's got earnings coming up relatively soon? Let's see. Should know off the top of my head, but when's, we could look at Apple or something like that. But you're going to see these get a little bit wanky, so that their earnings must be like next week. So that's not going to work. But you know, it's just, it's, you can trust me that it's going to basically get a little bit on the 31st. So that's next week also. It's just going to get to a point where it gets too wide to meet that rule of, you know, being inside of 2 or 3% between the difference here. Okay. Do you do calendars on the indexes, SPY, QQQ? I do. I have. I don't have any on right now. I actually have a long straddle on in the SPY right now. But that's because I thought we're either going to have a big correction or a correction to the downside, or a pop to the upside because of the way the market was, you know, just trading sideways for so long. I was just thinking it was due for a breakout in one direction or another, and I kind of talked about that in the daily market commentaries. But I actually held off. I was gonna put this GLD trade on today, and then I was like, oh wait, I don't want to make it look like I'm trying to pump this before everybody else gets in them. You know, I don't like to do that where I put on, when I'm vetting them, I go ahead and put them on. I mean, it's hard because I see the strategy set up so nicely to not do that, but I also don't want to make it look like I'm trying to pump and dump kind of stuff like that, like, you know, they do on mainstream media. So, but I'll probably be putting this on Monday if nothing changes. So watch out for those on the daily market commentary. I'll be talking about this in there. Does that make sense? For bullish, is it a reverse strategy to put to call calendar? So I'm not really sure what your question is. I think, but what you might be saying is this a completely opposite strategy from the call calendar, long call calendar? Then the answer is yes. Oh, Jake, I didn't see the rest of your question. So do you use the same parameters? I do. As a matter of fact, with this GLD, as you can see, from, you know, these are exactly the same from the D's to the Jan. So I do follow that rule on this. Does it mean that this strategy, we have to be right on the direction in the very long time frame. You do need to, if it just traded sideways and traded sideways for a very long time and volatility expanded for you, then you would benefit from it. But you do kind of need to be directionally right. Anytime you're doing a debit spread, you need to have a lot of things going for you. You need volatility to expand, and you need a directional move rather quickly, because even if you have a slow burn in the right direction, that theta decay is going to eat away at possibly at the same rate as the increase in the underlying. Okay, so and that's why I love selling strategies, because then you don't have to be directionally right and you can still make money. You can be directionally wrong and make money. And I've proven that. I'm directionally wrong a lot. No, but and that's the thing with being directionally right is right or wrong is one of the reasons why I've gotten completely out of like futures and even just trading stocks for that matter. Plus, I think stocks take up too much of your capital. But gotten away from like futures trading and stuff like that is because you have to be directionally right to make money. Options, you don't. And that's the beauty in options. If you can set this up in the right environment, the right way, then you can be directionally right or directionally wrong and still make winners. So, that's what I preach all the time, which is why I love selling options, is because that is the ultimate case where you can be directionally wrong and make money. Whereas this one, anytime you're doing a debit spread, you need to be directionally right. Using it makes it, yes, it does. But something like GLD, if you have a pretty strong assumption to the downside, which I do, if the market goes up, GLD gold is going to go down. I mean, because it's a flight to quality, right? You're going to get out of something that's safe and get into something that is a little bit more risky to take advantage of the upside, which is a stock. And stock is more risky than something like gold, right? All right, so basically, guys, this is the earnings webinars. There's like 10 hours, over 8 videos for the earnings trades, all my favorite trades for earnings. This is the time I get really excited. This is where I make the bulk of my money. And I know somebody was talking about in one of the other webinars, isn't earnings a crapshoot? Well, in a sense, if you're thinking about it's a crapshoot on directionality, well, yes, because any directional assumption is somewhat of a crapshoot. But this is the only time that literally you are going to get volatility to crush. And when that volatility crushes, you can be directionally wrong, and that's where you're making your money. Like literally, you could be directionally wrong to the point where the market comes down and like kisses even your strike, and you'll still be profitable. I've even had times where volatility was so high and it crushed so much that I was directionally wrong, and I had in the money options that I made money on, which is hard to do, but it does happen, and it's the beauty in this. And at the end of the day, what I try to teach is high probability trades and how to increase those probabilities, because probabilities are the probabilities, and that's the way to get ahead in trading, you guys. Like trying to always pick directionality, trying to always trade with the charts doesn't necessarily create consistent winners. But when you increase the probabilities of success by trading with my rules, you guys will do better. And this is only for 36 bucks, and literally you could easily pay for this in one single trade. If you guys have been following my daily market commentaries, the trade and win was a win today, and it was better than $36. The Amazon trade was even, a lot better than the $36 to go with that, following those rules. So if you guys have enjoyed my instruction, especially if you learned anything at all, even if it's something slight, you will learn something in each and every one of these different webinars as well. And your chance to get it for 36 bucks is a steal. So the bottom line is, you guys, the best way to become a better trader is constantly learn. Obviously, I've seen a lot of you guys in here. You guys are doing that, but that in and of itself is the first step in it. But basically what I'm trying to say is becoming a technical trader or just trying to trade with directionality isn't going to be enough to get consistent winners. So the best way to get ahead in this game is probabilities. That's the way I teach it, how to play the probabilities. And when the probabilities go against us, even more important is how to stay mechanical to increase your probabilities even further. That is the best advice I can give you, is to stay mechanical, and I teach you how to do that with like strangles and everything else. This one way to stay mechanical, and I forgot to mention this even in the call calendar one, is you can roll that if this market is going up against you, all right, you're not getting that directionality, you can roll this short put out in time, continue to collect more credit, and pay for that debit that you got. So do that as well, roll that put out. Try and go to the same strike. I don't want you to really create a vertical spread necessarily, but try and go out to that same strike, collect 10, 20 more cents, probably 20 cents or something like that, and continue to roll that out, get that theta decay, and hopefully it'll end up paying for that debit. So that's how you stay mechanical with this. And darn it, I forgot to mention that in the call calendar one. Also, we're offering this today, so you guys go ahead and click on the window. I'll throw it in there. I forgot to throw it into the thing there. I'll copy and paste it right now and throw it into the chat. So we've been talking back and forth in the questions. This link is in the chat window, all right? So just go there and you can click on add that to your cart or whatever and take advantage of that. Also, if you have any questions, you can call us at 310-598-6677 or email us at trading@protraderstrategies.com. So what do you say? Go ahead and click on that link. It's ready for you. I think everybody can see it. I sent it out to the entire audience. Also, I just want to thank you guys all for participating in this. Later webinars, I'm going to be drilling down on different options components, how I trade the options, when and where I find trades appropriate. For me, you have to look and see if it's appropriate for you, like that trade in gold. I'm probably going to be talking about that in the daily market commentaries. How do you get Chuck's asking, how do you get the daily market commentaries? Reach out to us at trading@protraderstrategies.com. It's a different, that is for our premium members. So, and if you're a premium member, you basically have all access to me as well. So, and you get those daily market commentaries and you get the webinars and everything else. It's a really good deal. But reach out to us at trading@protraderstrategies.com. We can get you set up with that chop, because those are really useful, you guys. If you like, those are like little mini webinars. I mean, I try and keep them quick, but they end up being about 10-15 minutes. But I basically go over everything. I go over the everything that's going on in Europe economically, here in the United States, all the different economic data points, go into detail how I think they're going to affect the overall markets. And I also give them, like if you've been watching those, I know quite a few of you have, the gold trade. I've been itching to get short, and I think I'm going to pull a trigger on that tomorrow. So, Monday. So take advantage of this, you guys. That's how you get it. The other stuff, any rationale to go with the half standard deviation 35 delta for the short side. Yes, if you are more bearish, in the near term, then I would go with the 35 delta. If you're a little bit less bearish, like you think maybe even with like gold, you're going to get a bit of a bounce. in gold, then you could go a little bit tighter, something like that. Actually, gold, I don't think it gave it's necessarily the upper. Yeah, I went with the 119s, but in that gold, I was looking at those 119 strikes. The reason why is I was looking at these 119s. One of the other things, the reason why I did that is because, see, it lines up with this point of control where the most time and volume has been spent. So I have a feeling it might go down there and hang out, and that gets me right below that, so that those puts have a better opportunity, in my eyes, to be able to decay worthless. You also have the 200-day moving average lining up with that, so that's going to act as a pretty good support. But I think what we're going to see is like a boom, maybe a little bit of rally up there, and then take off down for me. So that's usually what I do when I'm kind of looking at these. Also, I kind of look at some of these technical things, support and resistances. Maybe you look at the Fibonacci's. You could throw up fibs. Of course, I don't know why my fib's not going to work right now. So you could look at like Fibonacci, throw that up there and say, okay, well, this is going to act as the support. So you can do stuff like that and say, all right, well, it's going to bounce off of that and then take off down. So play it however you like to use those things. If you thought that this was going to act as a support, you might go to the 45 delta and do those 120s. I think that the real support is going to be right here around this 19. That doesn't mean it doesn't seem to be the same video. This is on trading success, not earnings. Are you talking about in the chat window? Oh, did I put it? Isn't this yeah, this is option earnings with options. So if you're watching this on delay, also if you're watching this tomorrow morning when we send this out on Saturday on your rewatch over, or if you're just getting this sent to you via, you can also pause the video and hit this if it's not in the link. But this is the options course for earnings season, $36. It's a steal. That makes sense. Is this course for the calendar options during earnings or any time of the year? It's any time of the year. You can use this any time of the year. The reason why I like this so much right after the earnings is because your probabilities of expansion and volatility going into that earnings with that long put are much greater. So, when I'm talking about playing the probabilities and you can only, your success is determined a lot of times at the setup of these strategies, just like you wouldn't want to sell in low implied volatility, just naked or a short put spread or something like that, because if volatility expands, that hurts you. With a debit spread, we want low volatility and have it move higher. So in order to have it move higher, it's not a perfect system, because if it's really low, it could go even lower, but you're playing the probabilities that it's going to go back up into normalization, which is, the middle of that range in a sense. Thanks, Eric, working through this earnings course now. Take it easy. All right, Edward, thank you. If you have any questions, reach out to me. I'll help you out if you have anything about that. All right. It doesn't pop up before the shopping cart that offers that. Sorry, didn't go far enough to sign up. What's that? Is that link not working, Mary? So I just clicked on it. Whatever. When you do that, it goes to something else. So that's what you would do, is hit that there. Okay. Oh, it's working. Okay, it is working. Great. Cool. That's all I got for you guys. Appreciate your time and effort. Everybody have a great weekend. And if you can't take that, take it easy. JQ all over it again. Good to see you, JQ. Take care, everybody. Thank you. Thanks, Edward. Have a great weekend.